It's kind of wild when you think about it. Some meeting happens in Washington, D.C., and suddenly the price of a global, digital asset like Bitcoin goes on a roller coaster ride. Well, that link between the U.S. Federal Reserve and Bitcoin's price, it's one of the most powerful forces in crypto, but a lot of people don't really get how it works. So today, we're going to break it all down.
So yeah, how does this actually happen? How can a few decisions made by a committee about the US economy cause such massive waves for crypto investors all over the world? That is the big question we are going to unpack right now.
All right, here's our game plan. First, we'll pull back the curtain on the Fed's main tool. Then we'll trace exactly how its decisions ripple through the market and hit Bitcoin's price. We'll check the data to see if history backs this up, look at some key moments when the rules don't apply, and then wrap it all up with a practical playbook for you to follow.
Okay, first things first. We got to understand the main lever the Fed pulls to steer the whole economic ship. It really all boils down to one single, incredibly powerful number.
And that number is the federal funds rate. Just think of it as the economy's master interest rate. It's the price of money at the very, very top, and it sets the tone for basically everything else: your mortgage, your car loan, even the borrowing costs for the biggest companies on the planet.
Now, to hit its target for this rate, the Fed has a few tools in its belt, but the real heavy hitters are what we call quantitative easing, or QE, which is like a giant fire hose of cash into the financial system, and its opposite, quantitative tightening, or QT, which is when they start sucking that cash back out.
And now we get to the main event. How in the world does a tiny change in that one rate actually end up moving the price of Bitcoin? Well, there's a pretty clear cause and effect chain here, a transmission mechanism that we're about to lay out for you step by step.
So from a 30,000-foot view, it's basically an inverse relationship. When the Fed hikes rates, money gets more expensive, and big money runs for safety. Think bonds, stuff that pays a steady return. That's usually bearish for Bitcoin. But when the Fed cuts rates, borrowing gets super cheap, and all that capital goes hunting for bigger returns in riskier places. And that's what creates this massive tailwind for assets like Bitcoin.
This really happens through three main channels. The first one is the liquidity effect. Lower rates basically just turn on the easy money spigot. So with all this cheap cash sloshing around, investors get a lot more adventurous, they're more willing to speculate, and because Bitcoin has a fixed supply, it acts like a liquidity amplifier, which means any new money flooding in can cause some pretty huge price swings.
Second, you've got the opportunity cost effect. Look, when a government bond or your savings account is paying you basically nothing, the cost of not holding that safe asset is super low. It makes a non-yielding, speculative thing like Bitcoin look way more attractive, because investors are literally forced to go searching for returns somewhere, anywhere else.
And finally, there's the US dollar channel. Generally, when the Fed cuts rates, the US dollar tends to get weaker, and since Bitcoin is priced in dollars, a weaker dollar is like putting Bitcoin on sale for every investor using a different currency. This can cause a big rotation of capital out of the dollar and into alternative assets, like, you guessed it, Bitcoin.
Okay, so that's the theory. Sounds good on paper, right? But does the data, does history actually back this up? Let's take a look at the receipts.
I mean, this chart really says it all. The blue area is Bitcoin's price, and that green line is the size of the Fed's balance sheet. Just look at how that epic 2020-2021 bull run took off right as the Fed unleashed that QE4 money printer in response to the pandemic. The correlation is, well, it's pretty hard to ignore.
And here's the other side of that coin. When the Fed started to reverse course in 2022, that's the quantitative tightening we mentioned, and the balance sheet started shrinking, you can see Bitcoin's returns went negative right alongside it. That's what kicked off the crypto winter. It just goes to show this isn't a one-way street. The relationship holds true when things are good and when they're bad.
But, and this is a really big but, it is not always this clean and simple. While that connection is clearly strong, it's not some unbreakable law of physics. There are some really important nuances that can completely flip this whole relationship on its head.
Yeah, this quote here from ZeroCap really hits the nail on the head. If you look back at 2001 and 2007, the Fed was cutting rates, but it didn't spark a bull market. No, it was actually a giant warning sign that a recession was right around the corner.
Which of course leads us to the most critical question of all. If rate cuts can sometimes signal a recession, are they always a good thing for risky assets like Bitcoin? And the answer is a hard no. It all comes down to why the Fed is cutting rates. If they're cutting in a strong economy just to keep the good times rolling, that's incredibly bullish. But if they're cutting because they're panicking about a recession, that is a massive red flag.
In that scenario, investors tend to dump everything risky and just run for the safety of cash.
And then you have the classic priced-in effect. Remember, markets are always trying to guess the future. So if everyone expects a rate cut, that expectation is probably already in the price. So when the Fed finally makes the official announcement, it can trigger a buy the rumors, sell the news event, where the price actually goes down because the good news was already old news.
Okay, so putting this all together, with all this complexity, what are the key signals you should actually be watching to make sense of this all? Here is a simple macro playbook for you.
First, always watch the inflation reports. High inflation can tie the Fed's hands. Second, the DXY, or the US dollar index. It's often a mirror opposite of Bitcoin. Third, the 10-year Treasury yield is just a great thermometer for the overall health of the economy. And last but not least, track the Fed's balance sheet itself. See if that all-important liquidity is flowing in or flowing out. These 4 things together are like your macro dashboard.
And that leaves us with one final, pretty fascinating question. For an asset that was literally designed to be an alternative to the traditional system, Bitcoin is still deeply tied to the whims of the world's most powerful central bank. So as this market grows up, will it ever actually break free and forge its own path? Or is its destiny just forever linked to the Fed's invisible hand controlling that global flow of money?